Thanks for joining. And John as well. We got a few more. We're going to give it a few more minutes after 6 o'clock, just before we get started. So we're coming up on it. I appreciate anybody that joined, especially at 6 o'clock on a Thursday night before Halloween. I know a lot of people have families and children. It was not the most convenient time, but it was the best time that I could get it done myself. All right. Going to give it one more minute and we'll get started, but I'll kind of start talking. Basically, from what I could tell by the people that signed up, we have about 50% of you already know me and we have a relationship, either as a friend or client. And then the other 50%, from what I could tell, I do not know. So it might be a little repetitive to some of you, but my name's Scott Talley. I am the broker and owner of Five Market Realty. And as you can see my head here and my picture on the screen, they probably don't match up very well. That one's from a few years ago. I wish I still looked that way, but I am too lazy to get a new picture. I'll need to do that soon. So what we want to do here is, one of the things we want to do in our community, in our area, is be a resource to our friends, our clients, and people we haven't met yet. Give you good information so you can make a good plan. And I'll be honest with you. This is my first webinar. I've never done one of these. If you'd have told me a year ago that I would be doing a webinar from my desk, I would have laughed at you and said, really, I can't believe that I would be doing that. But 2020 has been an interesting year for all of us. Become much more comfortable in having to present things this way. And I've learned that it's a great way to get communication out to people, get information. And ultimately, our goal is to be a resource for you. So your plans in real estate, be it for your house, an investment, you can have information to make good decisions. Ideally, the day will come that you'll want to work with us. But if that day doesn't come, at least we can be a resource for you here in the real estate world. So getting started, several of you might already know what a 1031 exchange is. Some of you might just be a little curious, and that's why you've gotten on this right here. So to some of you, some might seem very beginner, and to others, it might seem like a whole new world. But what we want to do is, I want to give you good information to where you can take this and you know exactly what this is and how to start it and feel confident in it. Because the 1031 is truly one of the best absolute tools that we have in real estate. So again, I know we got some more participants. If there's a way anybody wants to make a comment or give us a thumbs up before we get started, we'll see here. I've got cheers from Brad. All right, thanks Brad for acknowledging. And like I said, this is my first go around on Zoom too, so I just want to make sure I'm doing it right. But there we are. So now we got five more participants, excuse me. So what we're basically about to get started. A lot of you know why you're here for the 1031. I'm going to run through what this is, how to use it, some of the pitfalls people get into, and then we don't want to take too long. It's Thursday night. I want you to get back to your family. So let's go ahead and get started and get this underway. Our first right here, we're going to take a look at what are we going to cover? What are we going to talk about? Outline it. This will also be recorded. I can share it online. I can send it to you, and you'll be able to reach out to me if you have questions afterwards, during as well. First of all, we're just going to define what it is. What is the 1031? Make sure you're clear on that. You start from the very beginning. And then second, big part, why is this helpful? What are the ways it benefits you? Why is this a tool that so many people use? Third, which is one of the bigger things about the 1031 tax exchange, it has to do with tax liability and long-term capital gains. To some people, that is a common word in their everyday language. To others, it's a foreign language. So I still want to make sure you understand how that happens. And then right here in the middle, number 4, we're going to go over the general rules and the basics of how to do it, how to get it started. And we're going to make sure you understand how to do it correctly. I've seen a lot of people in real estate, smart real estate investors, smart real estate people, make mistakes on these. They think they know how to do it right, and then next thing you know, they've made a misstep and they're paying their taxes. And then lastly, I'm going to give you a real life example that just happened that I think you can appreciate. And then we'll go over a few of the different types and then basically open up questions and hopefully get you good information that doesn't take up your whole evening. So right here on the first one, what is a 1031 exchange? I know several of you on here might already be thinking that I know what that is. Why are we wasting time? Let's just cover the basics. The 1031 is the like exchange of one property for another by adhering to the IRS code 1031. That's where that number comes from. It's an IRS tax code, and the reference to 1031 is where it outlines. That's the technical version. Simple version, selling one investment property for another without paying a long-term capital gains tax. And that's where the benefit is. So you're able to take money that you've made, and instead of paying a taxable event, you can roll it back into a new property. Overall, the tax code outlines a rule that allows you to sell and then reinvest money into real estate without paying taxes. It's a great tool. A lot of people just hear it as jargon. And one of the things is there's a few processes that can make people trip up. And you thought you knew what you were doing. You did one thing wrong. And next thing you know, you're paying taxes on it next April. So that's what we want to avoid. Basically, understand what it is. And let's kind of get into the first steps of making this happen for yourself and what I advise clients to all the time. Truthfully, I'm thinking now over several years, I've probably been involved in 50 plus 1031 exchanges on one side or the other. If I counted ones I was involved in where I didn't represent that person, it's probably more. So this has come from experience that I kind of learned on the job. And I've been doing this now 16 years. And in my 20s, I was scared to death of what this was. And in my 30s, it became like the back of your hand, knowing how to navigate it. So it's not complex, and we're going to break it down for you. Does anybody have a question or anything at this point? I don't see anything. If so, I will try to check, and we'll go from there. All right, next slide. Why is it helpful? Well, as the picture says, pay to the order of the IRS, all of my money. Taxes are part of life. We have to pay our part to society. We all agree with that. But taxes are everywhere, and they can be very burdensome. So there is a way here to help avoid a tax to reinvest. And that's number one. We're going to teach you how, show you how to sell a property, avoid paying that tax, and reinvest it. The number two reason it's helpful to you is hopefully you're selling your real estate for a profit. That's the goal, right? We don't want to sell for a loss. Reinvesting in better property. You might start with one house when you were younger, and the next thing you know, you can turn that into a better house that performs better for you. You can turn that into multiple properties. This is a great way to position equity into more things. Number four, I just mentioned, growing your equity, kind of a no-brainer. The more equity you have in real estate, the better positions you are. And then that leads us right to number five, which would be owning a rental property without any debt. Most people actually service some debt on the rental property with the hope of paying it off and getting to that point. Well, one great tool is to sell one property, reinvest the next to get to a better property, or buy it outright with cash. And number six is probably the most important to me. This is the part that I don't think as many people understand. The 1031 is a great economic driver. Commerce happens because of this. There are things that would not happen in real estate, and people would not have opportunities if it weren't for this 1031 exchange. Politics is always something that comes up. Don't care where you lie on either side of it, but I want you to understand the importance of this tool in real estate, not only to you, but to our economy, quite frankly. Now let's move on to a little bit more of the nuts and bolts. So understanding your tax liability. First, understand what is being taxed and why you want to do this. So the taxes you generally pay on real estate, like your primary residence, things you think about, are exactly annual property taxes. That's a big one. Here in Clark County, we have a pretty high rate. It's sort of a talking point right now, but that's going to vary across every town, every municipality, every state. But you're paying tax on real estate, income taxes on real estate. That applies when you've got that investment property that you're collecting rent. Most people like to have this balance out to where there's no tax due. But quite frankly, if you're not servicing debt and you own something outright, you're making income, and there probably will be a taxable event. So property taxes, possible income taxes. The ones people forget about is this capital gains that you keep hearing me say over and over. capital gains tax, and it can impact you way more than the other taxes, especially if you don't plan, because these rates are so much higher that if you're not planning ahead, you could look at 30, 40, 50, $100,000 in one clip. And this is what we want to avoid if possible. So what happens when you make a gain? Very simply put, you sell for more than you bought it for. Let's just use this example down here. But you bought a house for $100,000 some years back, then you sold it for $200,000. Your basis was the purchase of 100. You sold for 200. The gain is simple, $100,000. Now, let me be clear. There are other factors at play. You might have depreciated some things. You might have incurred some expense and made improvements. There are ways to make that not a clean 100, but just for this example, we're going to play with clean numbers. So you got $100,000 in gain. Well, here's where the taxable thing comes to you. This is what we want to understand. What is this tax rate? What am I paying? And how does it apply to me? This is where people start to get confused because, as we know, our tax code is pretty maddening. There's a lot of details in it. And here is the long-term capital gains as it is of today. So long-term capital gains means a tax based on something you've owned for longer than a year. Usually that would be real estate. And your rate is gonna be applied in a couple of ways. What is your income? And what is your filing status? So this is basically what's going to decide. Let's take a look at the slide here. You see this big number here, 0, right? That looks fantastic. Let's take a look at who gets a 0% tax rate on these things. Single making up to 40,000, married filing together making up to 80,000, filing single with 40, and the head of the household making 53.6. That 0% long-term rate is fantastic. However, the trick there is most people in these income brackets are not the most likely to have an investment property to sell. When they do, it's fantastic. They don't have to pay taxes. But the reality is most of the people selling properties in real estate for investment are going to fall into the 15% rate or the 20% rate. And so basically you're making over $40,000 about $1 and up to possibly 496 if you're filing together, 248 if you're the head of household. So 15% generally just comes into play at $40,000 once you get over that rate. There's another part of the world that makes more than that, and that's going to be your highest bracket at 20%. So, that's going to be over like $440,000, over $500,000. The two rates you want to pay attention to, most people are falling into 15%. The next folks are falling into 20%. Simple numbers. If you look at it, it's $15,000 to $20,000 per $100,000 worth of gain. I had somebody mention to me, well, that's not too bad. Well, you're kind of right, although $15,000 is a lot of money. But the reason it's not too bad is at the moment, we are in a very good situation with the long-term gains tax. When you look back over history, they've been much higher. And so the last 20 years or so, it's not been high. There's actually a school of thought by people, maybe you do want to pay right now, because if you hold on and don't 1031, you could possibly be paying at a higher rate, depending on what happens in the future. As most of us think, we usually get fear of taxes going up. So now that we know it's 15 or 20%, let's move on. What are the rules? How do we do this? How do we get started? How do we do the 1031 exchange? Folks, it's actually very simple, but people that don't know confuse you. They start talking about things and then you think you know more than you do. So number one, very simple, get a plan before selling a property. Don't fly by the seat of your pants and go, somebody came along and buying this property and I'm going to sell it to them and then I'll do my 1031 exchange. Now you need to know what you're doing beforehand. Number two, please know this is an important part of the skeleton of a 1031. You need a clause in the sale contract of your property and the buy contract of your property. You have to have a clause that states that your intention is to do a 1031. And I'm going to give you an example of that you can use. So that's number two, clauses in the contract. Number three, this is kind of where the jargon comes in. You have to use what is called a qualified intermediary. Now, that qualified intermediary is basically a third party that's going to hold the money that you make off to the side and then send it to purchase the property. And another term for it that you hear in the real estate world, real estate world is QI, qualified intermediary. If you hear me say QI in this presentation, qualified intermediary. So plan it. You got to have clauses. You got to have a third party holding that money. And these are the numbers that people get mixed up on. Number 4, 45 days from your closing date to identify your purchase. Now, once your property goes under contract, you can start looking then. It's from the date of closing. And the other thing to note in those 45 days, you don't have to just choose one property. You can choose 10 properties. It's probably not as much as 10, but the point is that you have to do your research. And what you do is you basically find the property, and then you have 180 days, step 5, to close it. So very simple. This is the skeleton. You could probably walk away now and go, got it. Thanks. Appreciate it, Scott. Not too hard. But number 1, plan ahead. We'll get into that. 2, have a clause in it. You've got to have a clause in both contracts. Without it, no 1031. Qualified intermediary. This is a big part of it. You can never touch the money. We'll get into that. Number 4, you got 45 days to find it, and you got 180 days to close it. That's the simple nuts and bolts. Let's dive in a little further here. What are the details when I say plan your sale? Talk to your CPA. You might not need to do this. There could be a reason in your taxes or the way you've depreciated something. There could be a lot of factors that don't mean the 1031 is ideal for you. In the recession we dealt with, I saw clients that were going to take a loss if they sold, and they wanted to because it helped them offset another taxable issue they had. Talk to your real estate agent. Number 2, I'm just not tooting my horn, but what's the value of the property? What's the expected time to sell it? If he tells you 2 weeks, that's great. If he or she tells you 9 months, we got a different issue there. So you've got to have that conversation before anything too. Start looking for other properties. What else do you want? Like what kind of cap rate? Do you want to own a commercial building? Do you want to own a residential building, student property? Just don't be having to run around haphazardly looking for something. Kind of know what you hope to find. And then line up your qualified intermediary or your QI. People can recommend this to you, myself, attorney, CPA. So there's your plan. And let me go back here. This is the clause I talked about. This clause, I can send it to you. It needs to be in the purchase contract. It needs to be in your sale contract. Seller may, in seller's sole discretion, elect to treat this transaction as a tax-deferred exchange pursuant to Section 1031 of the Internal Revenue Code. Buyer agrees to cooperate, so on and so forth. This is not the exact one you have to use, but it's one that works. It's vetted by an attorney. I use it all the time. And when you want to use it as the buyer, guess what you do? Very simply, you interchange seller and buyer. Buyer may, in buyer's sole discretion, and seller agrees to cooperate with buyer. Very simple here, but this is a little step that a lot of people miss, and it causes them problems because they forget about it. So let's go take a look at the next part. All right. Before, I just want to check, is there any, if you've got a question, feel free to type it in. It's a lot of talking, but we're moving right along. Hopefully it's clear and simple information that you're able to understand. But if so, just, I'll pause every once in a while to let you see. More details about the qualified intermediary. Remember what I said, the QI. Big thing you want to know here, you cannot touch the money. It doesn't need to hit your account. You don't even want that lawyer at the closing table giving you a check. You don't want it. So your CPA, your attorney, or realtor can recommend one. Use a person here in the Athens area named John MacArthur, done a great job. A lot of people in the Atlanta area use a company called Atlanta Deferred Exchange, and they're in the business of helping you with the 1031. The big thing to know is this qualified intermediary, QI, they are holding the proceeds without the money hitting your account. If this money comes into your possession, it becomes a taxable event. That's what you've got to avoid. And these people are pros at making sure that you don't run into a problem. So what I've got here is a little chart that I'm going to show you just how you need to visualize what happens to your money when you sell, to what you're going to do there. So first of all, let's start here. I chose yellow because it should stand out to you. Your proceeds from selling are going to go into the closing attorney's trust account, not to your account, to his account. And then from there, instead of going to your bank or a check to you, they go off to this QI, right? They go off to the intermediary account. Now, right here, some time could take place. Remember, 45 days to find it, 180 days to close it. Once you get the closing of your purchase, it's going to go to that closing attorney again, or a new one, depending on who you use. Into his trust account, never touching your hands. Closing attorney wires the money to the seller of the property you purchased. That money never technically got to you. And that's what avoids the taxable event. So you end up with the benefit of the ownership of this new property that hopefully is an improvement or that you have more equity in. Biggest rule to know, this is the pay attention slide. This is where smart people screw up. This is where people that think they know really good what they're doing, LLCs, everything, they make the mistake. Sometimes we have to scramble to fix it. You must buy as the same person or LLC as you sold to qualify. I'm not trying to do a comparison by apples to apples. I just thought the apples looked identical or close to it. And that's what you should think of. If you're going to buy as Jane or John Doe, excuse me, if you're going to sell as John or Jane Doe, you're going to need to buy that same way. Doing it this way, making sure the same tax ID or your social security number are basically the same on the other side when you buy. This makes it the easiest way. This is the simplest way to avoid problems. But there are some things, some options out there that if something's happening in your life, we got to do it a different way. We got some options for you. But I want you to know that if you're buying in this LLC, excuse me, selling in this LLC, you need to buy in the same. Otherwise, there's some steps we're going to talk about. Let's take a look at that. So you bought it when you were single and now something's different, or you bought it with a partner. Here's an example. You got out of college, you were going to be J.D. Rockefeller in real estate, and you got into an LLC with your partner, your college buddy. Option one, you want to do what's called a drop swap 1031. If you walk away from this understanding the drop swap, you know more about a 1031 than 90%, 95% of the population, and a good bit more than most people in the real estate industry. So this is a good one to pay attention to. When do you use the drop swap? And I know it kind of rhymes. So this is an example of your partner in a property. Just like I said, you bought a property with your buddy in college and y'all were going to take over the world. And you bought a property and now you want to sell it and do a 1031, but your partner doesn't want to do a 1031. He wants to take his money and pay the taxes. So that's what's going on. But what I just told you was you've got to sell and buy it the same. Well, if you and your partner are on an agreement, what are you going to do? You're going to do the drop swap. And basically, there's a couple ways to do this. Number one, before selling your LLC or partnership, you could change it to what's called joint tenants in common with a separate divided interest. So you go from 123 limited liability company to John Doe and Pete Smith owning a 50% interest, separate and divided. And then when you sell, you can divide up those proceeds. But you also want to make sure you send a letter to the IRS that states, hey, we're no longer an LLC. We don't want to be taxed as such. You can do that through the QI, CPA. I would do it through one of them, make sure the letter looked good before I did it on my own to the IRS. But the other way you can do it is, you could also change the deeds out beforehand. But basically, you're going to get out of that entity. And the biggest thing you want to know is the person that separates out, make sure that language is there if you do separate it. You're going to drop out of that LLC and swap it over. All right. You're selling as a single person, but you're ready to be in an LLC. Real simple. This one's not hard, but I'll give you myself as a prime example. What happens to people is they don't intend a property to be investment. My first purchase was a condo at Woodlake here in Athens when I was about 22, 23. Because of the recession, it was someplace I had to rent when I moved on to other places. I didn't sell it and take my gain out. Then I turned 30 and I'm still renting the place. I get married. I now have a wife. I start to have children. I own this property as a single person. Now, the first thing to do is I could put it in an LLC and add my wife as a member, or do I want to put it in an LLC to remove myself from liability? Well, this happens to a lot of people is they want to sell that property but they don't want to hold it as one person. So this one's actually pretty easy. If you own it by yourself, go ahead and deed it over to an LLC before you do the 1031. You might want to give it a little bit of time. I wouldn't do it the day before. But the other way you can do it is you can actually sell your property in John Smith, buy in John Smith, and then a little bit down the road, create that LLC as long as it's single member. You could actually, as long as you're the sole member of that LLC, you could buy it in a new LLC. This one's not too complicated. It just becomes about who you want to be a partner, and that might change a few things for you. So if it's your wife, if it's a friend, there's a few tools there that could change it. One thing you could do, let's say you sold as a 1031 and wanted to join a larger group. You got 3 buddies that own a big or buying a big building. Let them buy 3/4 of it in an LLC. You come in as a tenant in common, one little 1/4 chunk, and you have a separate divided interest. Your 1031 rolls over, and then down the road, you deed over your 1/4 interest to the LLC, and you're all equal, and you didn't pay capital gains tax. A little bit more complicated there, but like I said, you know where I'm at. I wanted to give you a real life example as we get towards the end of it. I didn't want to keep you too long. I appreciate the folks that have shown up on 6:30 or almost on a Thursday night before Halloween. Real life examples. This is what I was talking about before when I spoke about what happens in the world and why this is a good thing. So this happened just recently. It's 2020, and this is not the property right here, but it's something like that. These were student investment properties here in Athens, and client A and client B, who were 2 different types of people. Now, if you look here at client A had great properties. He had a low basis in them. Year in and year out, he would say, I'd sell, but I just, the taxes right now, I couldn't bear to pay them. So he had an extremely low basis, but he had a very high taxable gain. And he wasn't a seller for many years due to this. Well, we were talking in the summer, and I just mentioned to him, just, hey, that's what it's worth, and let me know if you need anything else. Your properties are worth that. And he said, I'm glad you mentioned it. And opportunities come about. So this seller on client A had an opportunity to help out and work with another business owner during COVID to come in and partner on another property to help out this business. And he asked me, can this work for the 1031? And I said, exactly. It's what it's for. So let's get the plan in place. You know what you want to use it for. Let's do it. So now an opportunity emerged because of the 1031. These properties don't come on the market. He's not a seller if the 1031's not there. He's just going to keep owning them. Client B, this fella bought a property when his daughter was in college, and he liked it. It was a 3-bedroom, and then he had another one. And he wants to increase his investments, but he's sitting low on cash. He doesn't have cash on hand to go buy 3 more properties. Client A's got 3 properties to sell. Client B wants the 3 properties. How's he going to get them? Guess what? He's got a lot of equity in his 2 properties. So what he does, he uses the 1031 to sell his lesser properties, and he's going to roll that cash into client A's properties and then get a loan to purchase it. So he went from 6 bedrooms to 12 bedrooms, and he was able to pull out this equity tax-free. Now, the other thing that happened here, client A helped another business in town, purchase, invested it. That business is going to continue during COVID. Thank you, 1031. Client B, he's not a millionaire, and he's not someone with a gazillion dollars. He's someone that's worked hard and, planning for retirement, just wanting to get to a certain level, maybe get to 12, 15 bedrooms. So down the road, there's some income and some more assets. So he's going to get there by smart planning. Both of them used the 1031 to get it done. And note, there's a lot of people involved in the middle. You had vendors, you had appraisers, loans. A lot of commerce took place just between these 2 individuals, all because of a 1031 exchange. Without it, none of this happens. It's a big part of our economy. It's a useful tool. It can help you get through the retirement, keep rolling gains into something better. I'm a big fan of it, if you can't tell. I'm going to see if no questions. I understand. We'll take a sip of water. We're almost done. I'm going to go over the types of exchanges. Now, I don't want to take too deep of a dive here because I'd rather talk with someone personally if you had an interest in one of these. And the reason is a couple of them are a little bit more complex. It would be a pretty long webinar on some of these. So the first one we're going to talk about is what we've been, the forward exchange, standard exchange. I hope by whatever slide we're on here, you kind of go simple. That's not hard to do, Scott. Thank you. Not a lot to it. That's what we've been talking about. There's 2 other types. You probably heard of the reverse exchange. Reverse exchange means you want to buy the property that you're going to buy before you sell where you would take your gain. It can be done. A little bit more hoops to jump through, a little bit more expense. I've had a few clients in the past that thought it would be no big deal, and then they sort of backed off of it. And, just because they didn't get the plan in place. This is doable, but what ends up happening, a property comes up that you want to buy, and you can't get there quick enough. Let's see. Somebody brought up a question. No problem. Let me go back here. So we're sitting here talking about the reverse exchange. And I would say if you're interested in that, let's talk one-on-one, because what happens most of the time, you find a property and you're so about it, you got to buy it, buy it, buy it. And your ducks weren't in a row because how quickly you had to act. The one that's kind of interesting, and I've got a client experience with it, is the construction exchange. The first one, the first thing to understand in every 1031 exchange is the money cannot touch your hands. That's where the construction exchange gets a little tricky. But I love this one. This one's pretty cool. So the construction exchange basically means that you can buy a property that needs to be improved, or a raw piece of land that needs to have a building put on it. And you can do this and use your funds. It's a little bit more complex. It's very doable. The big key is never let the money touch your hands. That's what we want to make sure doesn't happen. So sort of in a nutshell, again, this is one of these I'd like to talk more one-on-one with you if you're interested in this. You have a third party brought in, and this is what I'm talking about right here, to what is called a holding party or title holder. Now, what happens is, if you remember, we sell the property, money sent to the QI, but now you've got to build on that property, and if you use the money, it's taxable. This is where the title holder comes in. So the QI sends enough money of the proceeds over to the title holder, who then sits there and holds it. And then as the property is improved, that third party is also brought in with the construction. The QI continues to send money over to complete the property. A little bit more complex, but one great example was I had a client that was able to use this for his future retirement home. So he was able to buy a property in the mountains, build a house. He's obviously got to use it as an investment for a certain amount of time, but long term, he's smart. He's thinking ahead. He's going to have a place up in Highlands because of a construction exchange. So the forward exchange, that's generally what we've been talking about. There is a reverse, and the construction exchange can be a pretty cool tool as well. So we're right here at the end, and this is kind of the roadmap. I appreciate y'all coming, but I just wanted to give you the 1, 2, 3, 4. 1031s are nothing to be scared of. You just need to understand the steps, and then it's a slam dunk. Biggest part is step 1, plan it out. You got an investment property. Where do you want that money to go? What type of property do you want? What's the goal there? Go ahead and find the qualified intermediary. Go ahead and figure out what company you want to work with or attorney. Talk to your realtor, real estate guy. What do you think it's worth? What's a good cap rate? Should I buy in Athens? Should I buy in Milledgeville? Should I buy in Augusta? Should I buy across the country? As long as it's in the US, it works. Next step, the 1031 clause has got to be in the sale contract. Put it in the contract, close the sale of your property. Step 3, the proceeds go to the QI. You never touch them. Very simple. Line up that qualified intermediary and go from there. And then basically find any possible new properties within 45 days. I want you to keep in mind that can start when your property goes under contract. It can start before you get a contract. But once it closes, you've got 45 days. And then you've got to secure that contract and close it within 180 days. It's really simple. It's amazing that how many little miscues between how you buy and sell it, or how you sell and buy it, I should say, or a clause being missed is where people make the mistake and then they end up getting audited. You want to do this right. And it's simple enough, especially the straightforward one. But, one of the things we can't do is give you legal advice. Can't give you, technically tax advice, but we know, or I know these well, and I work with people that know them well too. Right here, this is the roadmap. This is our last little skit here. One silly little picture here. It's really bad Saturday Night Live skit called David Pumpkins, and also known as Tom Hanks. His whole stick was any questions. And since it's Halloween, I thought I'd throw it on here. And, probably don't know what I'm talking about, but then here's a professional picture for you. Basically, I know on most of these, most people do not post a question or ask them. and that's okay. But if you've got one, please let me know. We're now about 35, 36 minutes in. I hope this was a good understanding for you of 1, 2, 3, 4. That's how I do a 1031. And, I'll go to the next one with the contact information. If you've got a question, these are the best ways to contact us. Contact me. Personal website is athensrealestatetalk.com. Email Scott at 5M Realty, and cell phone. Now, one thing I do want you to know is you jumped on here for various reasons. We had a few real estate people wanted to see a little bit more of the details of a 1031. And it's not doesn't mean that you have to contact us about a 1031. If you're sitting in your personal house, you're just like, man, I really like to know what my equity position is. We'll do that for you. We can help you. Not everything has to be a sale. We want to be a resource to you. I want to be a resource, our company, that when you have a question or need help, that's what we're here for. So know that you can reach out for those various things. I haven't seen any questions. I'll give it one more check. That assumes I must have done an excellent job and giving you a great rundown of it. But what we are going to do is this will be posted. It'll be viewable anytime. I can also share it with you. And seriously, feel free to reach out directly and just ask a question. I've been on a ton of these.